Now, as investors, most of the time we spend a lot of more time evaluating the performance of a company from a profit and revenue growth perspective, which is important. They're important factors. However, a lot of times investors lose sight of the risk side of the equation. And one of the realities of investing is that we will make decisions, guaranteed, every single one of us. We are going to make investment decisions that are just not going to work. And we could do all the analysis. We can analyze the balance sheet and income statement and calculate a million ratios and calculate the cost of capital to like 5 decimal places. We can do all that work. We can size up the industry. We can size up the external environment. We can do a valuation that tells us the stock is discounted. We can do all that work, and you know what? It still may not work out. It's still, we have all the numbers and behind us, but it just might not work out, despite doing all of that due diligence. Now, one of the things after doing all that kind of work, one of the traps we fall into in investment, this is more of a behavioral thing, is because we've done the work and we're so sure and confident that the analysis that we've done is true and is going to pan out, we often stay a little bit more married with our investment decisions, and oftentimes emotion then and ego to a certain extent starts to cloud our judgment, and often that from a long-term perspective will lead to worse outcomes. So one of the things that's really important is to just also be comfortable with the risk profile of a company, because in the eventuality that the investment goes wrong, that we are kind of disciplined enough and emotionally kind of with it that we're aware of that possibility, so we can exit, so we are more prepared and ready to exit and preserve our savings. Because as much as it's important to grow our savings through capital gains, and from that perspective, it's just important that we preserve our savings, especially when things don't work out. So one of the things I want to leave you here with is trying to get through here is that when you're making an investment decision to buy a stock, and you just say, you know what, I'm going to buy it, it's really important to have an exit strategy. In the event that, you know what, the investment doesn't pan out and you end up in a loss position and you start losing money, it's really important to set caps in terms of when you're going to buy, let's say I'm going to buy Apple stock, like how much am I really willing to lose on the investment? If it's 5%, 10%, you got to set that out, and you got to stay disciplined to it. And in the event that the stock, like Apple, if it went down 10% or 15%, I have to be disciplined enough to say, you know what, I know I've done a lot of work on it, and it seems like the analysis is great, and it looks like the company's in good shape, but you know what, I need to preserve my capital. I'm going to sell it and maybe come back another day and fight another day for it. It's just having that kind of goaltender mentality to, you know what, I let in a bad goal, I got to shake it off, and I got to get up, clean up my pads, and get on with it. And that's an important concept here for us investors is managing that risk and that possibility that you're going to lose money. So it's just important also to have when you're setting out deciding to buy a stock, have an exit position. Have it say, you know what, I bought the stock at $100. If the stock goes down to $75, if the stock goes down to $85, I'm going to sell. It means from that perspective, you lose money, but the reality is you're probably going to save money in the long run, because that money that you've preserved can be reinvested in other investment opportunities.